Hi, welcome back to the video on probabilistic analysis. In this video, we will go through the following three questions. What is probabilistic analysis? And why use it? Lastly, how does it work? So what is probabilistic analysis? Probabilistic or statistical analysis is not a new concept. Probabilistic or statistical analysis takes in data and calculate various statistics like probability of some variable being greater than 0 or being greater than some number, the mean, the variance, and more. Engineers and scientists have been using it for a long time, and I'm pretty sure people at Wall Street uses it as well. Unfortunately, I have not came across a product that can analyze stock in this fashion, and therefore I created a software called Crystal Ball. Crystal Ball computes various technical indicators, combine them, and calculate their individual probability. Then it selects the best probability for each different day. So you might be wondering, why use probability and statistics when investing? Well, the best poker players in the world uses probabilities to make their bet. And investing sometimes is actually very much like gambling. You're making a bet on some stocks. So I'm surprised that there are very little resources that talks about this topic in the world of investing. So let me give you an example. If you know that you have 50% chance of making 3% return, let me ask you, what is the ideal amount that you should lose? Or what is the worst case amount that you should lose? It's actually pretty simple, no? If I flip a coin and if I get 3% return every time it hits, then roughly speaking, every time it tails, I should lose no more than 3% as well. If you repeat the process multiple times and you lose 4% on average while making 3% on average, you will lose money. So the problem is how to figure out the average return. If you can figure out the average return, you could probably create a stop loss to limit your losses. This will ensure you to get a consistent return as you make your investment for a long period of time. Also, it's also interesting to know what is the probability of a price being higher than a certain price point. These are all important questions that a lot of tools have not been able to answer, but Crystal Ball has this ability. So we are going to take a look at how to use Crystal Ball to make rational investment or trading decision. So let's take a look at Crystal Ball. So this is the homepage of Crystal Ball, and if you scroll down here, you'll see that Crystal Ball will make investment suggestions for 1 month ahead. So this is for December the 17th, and right now we are in November. Sorry, the current date is November 17th. So it's roughly 1 month ahead. We won't be using the suggestions below, but instead we will be using another ticker, ADS, which is for Alliance Data System Corporation. So on the top here, you'll see price related information. During trading hours, the prices updates automatically, almost real time. And down here you see our probabilities or our predictions for various trading days ahead. Okay, you can see the latest date being used to generate all this prediction here. It's basically using November 16th's price data to generate all of these predictions. Now each of these blocks here contains prediction for different trading days ahead. And the way the probabilities or predictions are generated is as follows. It first generates a combination of technical indicators. So let me show you what I mean by going to the probability page here. So if I scroll down, you will see a lot of different technical indicators and different combination of them. Okay. So for those that are new to investing, technical indicators are generated from price movement. It can be used to time your entry and roughly estimate how much you can make. But they will fail, and they fail quite frequently. And that's why you will need to know the chances of the chances of succeeding when you use a particular technical indicator. So after Crystal Ball generates a combination of all sort of technical indicators, it computes the probability for them. Now once Crystal Ball have all of this probability, it will pick out the one that it thinks is the best one. And this is done by Crystal Ball's AI. The probability that you see here is the best probability, but the best probability doesn't mean that it's the highest probability. As you can see, this is roughly 63%, but if I go down here, I could find something that is 74%. So it's taking various different factors into account. It tries to optimize for the trustworthiness of this probability, the reward and risk ratio, and a lot more. The goal is to help you make a well-informed decision. So for now, we will go back to the summary page. So as I mentioned earlier, each of this block here represents a date on the summary page. And Crystal Ball tries to assign probability and average return for each of these dates. So for the 10 trading days ahead, you can see that the probability of increasing is around 61.59%. To be exact, this 61.59% means that the chances of the price on December the 3rd has 61.59% chance of being higher than the closing price on November 16th, which is 198.04. Okay, and the average return is expected to be 1.9%, with the expected price shown on the right hand side. Now this won't always be, it doesn't mean that the price will be this, it just means that on average it would be around this value. It could also be a negative value, but it could also be it could also be much higher than 1.9%. It is just the average of all the numbers that have happened in the past. And lastly, you will see the technical indicators being used to generate this probability and this average return. So I'm going to expand this probabilities here. So if I scroll down, I can see the expected price, the expected probability change over time. You can see that the probability increases as you hold it longer, and on the 120 trading days, it just drops slightly. So looking at all the probabilities, it seems like the 60 trading days ahead or 3 months ahead seems to be the best investment time frame. It has 80% chance of closing higher than November 16th's price, and the average return is relatively good, settling around 11.38%. Okay, so let's do some math. I'll bring up a Word document to do some math on it. So remember that Crystal Ball thinks that ADS has 80% chance of closing higher than 198.04, which is the price on November 16th, and this is for 3 months later, right? So let's write that down. ADS is at 198.04, and the average return, the average return is around 11.4%. So we are going to go through an exercise to actually calculate the stop loss using the information that we have obtained from Crystal Ball. A question that a lot of people might be wondering, or at least when I was just beginning investing, is about, what should my stop loss be? What should be the ideal stop loss? Well, the stop loss, as you will see shortly, is actually related to how much you can make. So so let me explain a little bit further. The average return can be viewed as the return that you have 50% chance or more of achieving this number. So to rephrase that, when somebody tells you, oh, the average return is going to be X, it means that you have 50% chance of hitting X, or in this case 11.4% or more. So you have 50% chance that the return 3 months later will be higher than 11.4%. Okay, you have 50% chance 60 trading days later for the return to be 11.4% or more. Okay, since we know that we have 50% chance of making 11.4%, we want to calculate the discount rate that would ensure to ensure that you are profitable if you repeat this investment process multiple times. Okay, so let's see how are we going to calculate this worst case profitable discount rate. So worst case profitable, or actually it's more like the break-even discount rate. So we are going to calculate it using 1 divided by 1.114, or 1 added by 0.114. 1.114 comes from this guy, and this gives you 0.898. So if you want to calculate the worst case break-even return, you can calculate it as follows. You take 0.898 minus by 1, and that gives you minus 0.102, which is roughly 10.2%, or minus 10.2%. So in other words, you should never lose more than 10.2% to break even. Okay, so let's do some calculation. I'm going to bring up this calculator here. And yeah, let's do this. So let me give you an example. Let's say the first time I hit my average return, and then the second time I hit my break-even return. So the way to think about it, as soon as I hit my break-even or my break-even return here, I would immediately cut my losses. So this is about cutting losses, and when I make money around this range. Oops. Yeah, so this. So first time I make 11.4%, second time I lose 10.2%, and then I repeat this process again. Oops. And 0.898. Okay, so the answer is really close to 1. In fact, you still have a little bit of profit. Okay, you might be wondering, why am I not using 11.4% as my worst case return? So let me show you what happens. If I consider my break even return to be minus 11.4%, then my discount rate is going to be 0.886. Okay, so let's repeat the process. If I make 11.4% the first time and I lose 0.886, and then I repeat that process, I'll get 0.97. It's close to 1, but not quite 1, right? And so you have to be very careful. You have to remember that in the world of investing, everything is compounded, so you cannot use plus minus. You have to use a multiplication or a division type of sequence to calculate your losses and your wins. So that's very important. Okay, so I'll try to include links in the description below to talk more about this topic, and I won't go any further on why that is the case. Okay, so now that we know that our worst case return is minus 10.2%, we want to start considering how to make profit consistently, right? The goal of investing is to ultimately grow our money. So to make a profit consistently, or to make your investment positive consistently over a long period of time, you need to divide this worst case return by some factor S. Okay, so I call this the safety factor, S, and typically it ranges from 2 to about, say, 5. I would recommend somewhere between 2 and 5. You can also do 1 point something as well, as long as you believe that you're very good at timing the market. Then you can definitely have a higher you can have a lower safety factor, but you never want to go you never want to go below 1. Okay, so we talk about safety factor, and in this example I will be using a safety factor of 2. So I want to point out that why did I choose 5 as an upper limit, and the reason is because when you buy an investment, and stock prices are volatile, so sometimes volatility can actually drop drastically, and then because you have put in a stop loss, you might be kicked out by volatility, and when you're kicked out by volatility, then you might get frustrated, and then you might get emotional and stuff like that. And you know, if you get kicked out too often by volatility, your return is going to turn negative, because the moment you are more likely to be kicked off by volatility, that means that you're going to lose money consistently and not making any profit. So choosing the right amount of safety factor is very important. The higher the safety factor means that you're very good at timing your entry point. I personally am not that good, but and therefore I usually use, you know, somewhere between 2 or 5, which actually works for me. Okay, so back to our example again. We are going to choose s equals to 2. So let's calculate our stop loss return. So our stop loss return in this case is simply going to be minus 10.2% divided by 2, and that is basically minus 5.1%. Okay, so you take your worst case return, divide by 2, and then you get your worst case stop loss return. And if you translate this to a stop loss price, this is 198.04 times 1 minus 0.051, which gives you 18794. Okay, so 198.004 is the price that you I'm assuming that you are able to buy it at 198.04. If you buy it at a different price, say maybe 199, then you should use 199 here. Okay, it should be your purchase price here. So let's do a quick sanity check to make sure that this strategy works. We'll call out our I will use the calculator again. So let's say the first time I make 11.4%, the second time I make the second time I will lose I will lose 5.1%, meaning that I stop my losses at 5.1%. That is roughly 0.949, and then I repeat again. I make my average return, and then I lose my stop loss. So if you calculate that, you end up with 1.118 roughly, right? So that means you are making money, and you're making 11.8% in general, and that's pretty good. The S&P 500 annual return is roughly around 10% a year. If you are able to repeat this 4 times and then get to 11.78%, you know, you get extra 8%, and sometimes you get lucky, you know. You get lucky, and then your average return, your return might be at 20%, and then you stop at 5% stop loss. So it's pretty decent, I would say. So this just shows that this type of strategy work, but there are a lot more questions to be answered. So we'll discuss a little bit more on those. Okay, so you see how this goes. As long as you repeat this process multiple times, you should be able to hit profitability if you do it consistently over a long period of time. And this is simply based on the law of large numbers. So what we have gone through today is we have seen how Crystal Ball can help you calculate a rational stop loss using this methodology that I've just introduced. Relatively straightforward. Yeah, and we believe that if you follow this process, you should be able to make your investment performance much more consistent, and you will also be able to eliminate emotion. You don't have to ask yourself whether, oh, should I wait and wait and hope for something to change, to turn around. From my experience, that has never worked for me. Maybe I would say that the number of times that it worked for me is much less than the number of times that it did not work for me. So in general, when you just hold and you don't have an exit point, it generally doesn't end up well. Okay, and you get very emotion, and you don't need those type of stress. And we believe that this framework actually removes a lot of the stress, and it's very rational. Okay, there's one thing I do want to let you guys know, and that is the following. If your investment time horizon is longer, your stop loss is also going to be larger. And let's take a look at why that is the case. Let's go back to Crystal Ball. I'm going to go to the probability page. And I'm going to use 252 trading days because this is a year. You can see that in a year, your average return is roughly around 34.5%. So if we go back here, let's do a really quick, I'm just gonna put up some numbers. So the 1 year average return is roughly 34.5%. So if we use s equals to 2 again, you should be able to arrive at a stop loss return of roughly minus 12.85%. So you see how this goes. The longer you hold it, the more, because of compounding, your return is going to be larger. And because of your return being larger, your stop loss, if you use the same safety factor, will also be larger. And this has one good implication. You might think, oh, I'm going to lose a lot of money, but there's actually a good implication. It also means that you have a lot of room to wiggle around, and volatility is much less likely to kick you off when you have a larger stop loss. And this is why buy and hold has worked for a lot of people. This is the main reason. When you hold for a longer time period, your stop loss return is going to be much larger, and yeah, your stop loss is going to be much larger, so you're much less likely to be kicked out by volatility, and then you don't feel that you're unlucky or whatever. But still, I do think that you still need a stop loss, even if you are doing long-term investment, because otherwise, what if you made a wrong decision on some company and you just don't know when to exit? Maybe you have lost 50%. If you lost 50% and you could only make 34.5%, don't you feel that you are doing quite a dumb decision? And when I began, I had this problem too, but now I've learned my lesson. I know when to stop, and I hope this will help you guys to figure out where your stop loss is as well. Okay, alright, so this is all about probabilistic analysis and stop losses. I hope you understand how you could use probability to help you manage risk, and I believe that managing risk is one of the most important skills when it comes to investment. It has certainly helped me, and I hope that you could use some form of risk management in your daily investment routine as well. So I do want to emphasize that stop loss is only one way to control risk, and there's many other risks to control when it comes to investing in stocks. But when it comes to ETFs, I think all you really need to do is probably you need to know your stop loss, you need to know market risk, and that is actually, and if you can do a little bit of technical analysis, that would be really sufficient for ETF investments. For stocks, it's a little bit more complicated, and I might talk about that in some other video. Okay, so we have talked about stop losses, right? And we have seen how to calculate it using crystal ball. There is one slight problem, and that is volatility kicking you out from your investment because of your stop loss. So how do you remedy this? Like, how do you select an entry point such that volatility is much less likely to kick you out from your investment? And when it does, it means that you have protected yourself, because when something really, you want to time it such that if you buy it at a good time and volatility still kick you out, it's probably a good idea to stay away from that stock for maybe at least, I would say, 2 weeks and see what happens with it, because there are some unknown factor that's happening to the stock right at that moment. So the problem is timing, right? If you can time your entry such that you can avoid being kicked out by volatility and potentially make more money, because when you time it, usually you can increase your return a bit more. So in the next lesson, we are going to talk about technical analysis, because technical analysis actually helps you with timing. Okay, it will tell you, oh, this could be a good time to buy, but you still need to put in your stop losses, because sometimes things go sour, and that's how the stop losses protects you. Okay everyone, this is the end of the video. If you like this video, please give it a thumbs up. If you have any suggestions for me on the video or for crystal ball itself, please leave a comment below, and I'll be sure to get back to you. And I'll see you in the next video on technical analysis. Have a good day.